Let's break down today's action. We have Brian Boyle from Boyle Capital. He's worried about the length of this bull market, but says there is still one sector investors should buy into. Tom Lydon from Global Trends Investments telling us how he's changing his investment strategy. Mike Chadwick of Chadwick Financial picking one area of the market you probably never heard of or considered anyway. And Larry Shover in the pits of the CME. Larry, why, for goodness sakes, are you so sure that Janet Yellen's Fed will not drop the word patience?
David, I think she will drop the word patience. Maybe that's a misunderstanding. I think that's something that the market intellectually believes. Emotionally, maybe not. And that's why we're marked with so much volatility and indecisiveness in the market.
All right, well, hold on a second. Larry, hold on. If you think that FOMC, and forgive me, I thought it was the other way. If you think they will drop patient,
yes.
Why hasn't the market freaked out? Because we have a couple of sectors that are in the green.
Yeah, absolutely. And I think it's because intellectually the market understands and embraces the fact that the right economic figures are going in the right direction. Wage growth, unemployment rate is going down. We do also understand that there's counterbalancing forces like GDP is going down. That's not good. But the right forces are going in place. We're starting to heal on our own. So the market intellectually is understanding that, although there's a lot of emotion still, as we saw today, a lot of volatility pocked in the market because people, on the surface don't really understand what's going to happen when they do raise rates. But Yellen will drop that phrase, giving her that flexibility to raise rates between June and the end of the year.
Hey, Brian, let's get to people who are going to be watching what happens, seeing the market reaction. Is your recommendation to dive right in and start trading, or to sit back, wait till the dust settles, no matter which direction the markets move on this?
We think you want to be very cautious right now and definitely don't jump in based on what you think will happen tomorrow. Look for good value. There's still some opportunities in the market, but look for things that haven't done as well as the market over the last couple of years. That's where the opportunities are. And whether you wait a day or two, we don't think it makes a big difference.
Mike Chadwick, you think the markets have totally lost perspective of the real economy, that they've gotten way ahead of the economy? Explain.
Well, I mean, let's face it. It's been QE all along. Janet Yellen, all the central bankers across the world for the last 6 or 7 years have been using every monetary policy tool they have to talk markets up. Whenever they come down, you get a central banker out there talking about how they're going to ease. Good news is good news. Bad news is good news. None of us really know what they're going to do tomorrow, but I think the market is operating on QE promises. In fact, I think the Fed's got themselves backed into a bit of a hole, and Miss Yellen tomorrow is going to need the luck of the Irish to help dig her way out of it.
Okay, well, what's the hole, Tom? I mean, she's basically done what she said she would do. Hold on one second. We just got Oracle numbers, and Adam Shapiro has them. ORCL. How'd they do, Adam?
It's a miss on what the Street was expecting regarding revenue, $9.3 billion. The Street wanted $9.46 billion. Earnings per share, 68 cents. That's the adjusted earnings per share, right in line with expectations. Liz?
Okay, Adam on Oracle, and this, of course, is a widely held stock. We're just watching the reaction here. It's pretty much flat, I believe, since the close. Closed to $42.87. The bid right now, $42.87. The ask, $42.64. Back to Tom Lydon. Give us your sense of what happens here, and are you feeling still pretty bullish about equities? Still the best place when you're looking for better yield?
Well, absolutely. And as investors are waiting for Yellen's comments tomorrow, let's get back to the fundamentals. And really, in the ETF world, something that we pay a lot of attention on, why not invest in companies that invest in themselves? So there are 3 specific buyback ETFs, PowerShares and TTFS, which is the trim tabs float shrink, and also Cambria has a shareholder yield. So if you want to find stocks that are buying back their own shares and also increasing yield, rather than waiting for hear what Yellen has to say, here are 3 ETFs that I think are a great bang for their buck.
Well, Tom, let me push back on you for a second, because speaking about whether the markets are living in fairyland, a lot of people are worried about companies borrowing money to buy back their own stocks in order to raise the stock price. It looks like a fixed game. It looks like some kind of pyramid scheme. Why do you think that's a good thing?
And it's a great point, because it does come out from time to time, but that's not the case. That's the exception rather than the rule, David. I mean, you look at the balance sheets of these companies here in America today. Since the low in 2009, over $2 trillion have gone into buyback programs. Last month, over 120 billion alone, where investors took out $10 billion of equity mutual funds. So the numbers speak for themselves. Here are some managers who really do a good job in selecting, because ETFs are mostly index-based. PowerShares has a great index for you. You've got managers in TTFS and also the shareholder yield ETF that actually make those picks for you. So if you like buyback, there's some great choices.
Okay, let me just say about Oracle, Larry, that Oracle is hiking its dividend. So again, there are a lot of options out there for stocks that are going to give you better yield than a 10-year treasury. But what are you seeing in the pits of the CME as we get closer and closer to what could be a pivotal Fed meeting? Are people scared and going into treasuries, or are they going into equities?
Well, I think they're going into equities around the world, especially in Europe. When you consider, when you put currency against that, the European currencies really aren't up that much on the year in U.S. terms. So a lot of people think we've seen the end of the U.S. dollar run-up. This is a great time to get on board for European currencies, especially in this cyclical sector. That ahead of the U.S. When you consider the fact that, like, when it comes to yields, you have to go out 8 years in Germany to get a positive yield. Oof. And to put that also into perspective, a double B minus company in Europe equates that to the 10-year yield. Right. So what are you going to do? That's what keeps our yields artificially low.
Well, that scares the hell out of a lot of people. And Brian, it leads me to a question, whether it's negative interest rates or too much stock buyback, borrowing for stock buy. What concerns you most about this market right now?
What concerns us is just what the guest alluded to, the fact that interest rates are so low around the world, you can't really tell what the right rate should be for stocks and therefore what people are willing to pay for earnings. The S&P is estimated to earn $121 a share this year, so at current levels it's about 17 times earnings. That's a pretty fair multiple, in our opinion, for the market right now, and after a 6-year run-up, we think it's time to be cautious and look for things that haven't done as well. Make sure you buy value.
Okay, good stuff, guys. Brian Boyle, Tom Lydon, Mike Chadwick, Larry Shover. We're going to be checking in with you in a couple of minutes when the S&P futures close. Thanks, gentlemen. Liz?